Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I had a few moments here on a Friday afternoon and I had a subscriber ask me a couple of different times to take a look at United Rentals, and it's not my personal cup of tea, but I did have a few minutes here, so I want to take a look at what I would consider to be the pure growth stock United Rentals. Now, let me start with the negatives. The big negative I see is the company has a lot of debt and it's only BB rated, so it's not an extremely high quality company. But if I look at the company's historical record, earnings were stable coming into the Great Recession. Then they collapsed. They actually generated losses in 2009. But if I look at this company since coming out of the recession, it actually was pretty highly valued because, again, we had some bad numbers. We had PEs up in the 70 and 80 range. So that's a very hard headwind for a company that, to face. But if I drop a couple of more years off here, I'm going to drop this down to a 10-year graph. Now we see a company that had enormous growth, almost 29% growth, and it's only trading at around a 13 multiple. I think that's a real interesting point. Now, if I look at performance over this time frame, it's almost doubled what the S&P did. Of course, the company pays no dividends. So even though the company is significantly undervalued and even though it's trading at a low multiple, because of this extraordinary growth rate, the company has generated very attractive total returns for its shareholders since coming out of the recession. Actually, if I go back all the way to when it came out of the recession, even when it was highly valued, once again, because of the growth, it generated substantially better rates of return than the stock market. Now, I want to try to give you some insights into how this happens. I used to call it the double-double, but what I'm really talking about doubling are the earnings. Okay, but I want you to notice here, I'm going to go back to this 10-year graph because we have some anomalous numbers here. The company earned $3.76 in 2012. Then it grew earnings by 31% to $4.99. Then it grew earnings by another 41% to $6.91. And then it grew earnings to 16% to $8.02 by 2015. Now there's your first doubling of earnings. Now what we've got again, we have earnings went up another 8%, which was kind of a bad year. Then they went up 22%, 54% in 2018, and they're forecast to grow at 20% this coming year. Now, for whatever reason, and I haven't researched this stock thoroughly, when I look at forecasting going forward, I see earnings growth expected to be about 13%, but the stock is only trading at a blended PE ratio of 6.7. Now, if I go back and look at this company historically through all the good and even the bad years, this orange line on this graph is a PE of 15. Okay, so it's very clear that, the stock has often traded at a PE of 15. The blue line is a normal PE of 12.7 over this long period of time. So, I've got kind of a low case and a high case. Anytime the stock got below that blue line, you can see it always recovered back to its historical norm. So when I'm looking at forecasting and I'm looking at the blue line, I can go ahead and bring that 12.7, well, there's 12.8, that's close enough. I can bring that low multiple and apply it to this graph. And so if I get a double here, if I can get a company that's capable of growing their earnings and the PE ratio doubles from 6.7 to, in this case, 12.8, not quite a doubling, look at the rate of return potential this company has if it does grow the business and can generate those kind of rates of return. The long-term growth rate for this company is expected to be 21% a year, but that's only by two analysts. So again, if I get to even a 13 PE ratio, I would average 35% a year on this company. Now, the company does have some risk. It doesn't pay a dividend. It has, to me, a lot of debt, but it does generate a lot of cash flow, and it does generate a decent amount of free cash flow. So this would be one that I would consider very attractive for those who are looking for a pure growth stock that is undervalued. The real risk here is the debt, but the opportunity here is that the stock moves back into a PE ratio somewhere between 13 and 15, which is where I think it belongs for a company growing this fast. The growth potential here is enormous, and the valuation is ridiculously low. I'm not sure why the stock is trading at such a low valuation, but I went and looked, I dug a little bit into it because I don't know this company. I want to be clear about that. But the company reaffirmed their guidance. If I look at their recent earnings, the stock's up 3% cent today, by the way, as I do this. They beat their earnings by 27 cents, and their revenue beat was 65. So, when I'm looking at this stock here and thinking about it from the standpoint of, is it a good investment? It sure looks pretty attractive to me here. The company is one of the leading rental companies, clearly in the country. It rents all types of equipment from, small equipment to even skid steers and tractor loaders, light towers. I mean, I don't know this company very well, but the bottom line is there's obviously a lot of opportunity in United Rentals. For those looking for pure growth and high total rate of return, you might want to take a closer look. Anyway, this was a subscriber request. There's a reason I covered this stock, but after I looked at it, I found it pretty intriguing on evaluation. If you liked what you saw here, don't forget to hit our subscribe button below. Thanks for watching.